In the introduction to A Random Walk Down Wall Street, Burton G. Malkiel explains that the stock market is a complex system that can't be predicted with certainty. He uses the concept of a random walk to describe the unpredictable nature of the market, where stock prices move randomly and are influenced by a multitude of factors. Malkiel argues that it's impossible to consistently achieve returns in excess of the market's average, and that investors should focus on diversification and long-term strategies rather than trying to time the market or pick individual winners. He also discusses the importance of understanding the different types of investments, including stocks, bonds, and mutual funds, and how they can be used to create a balanced portfolio. By understanding the basics of investing and the nature of the stock market, investors can make informed decisions and avoid common pitfalls. As Malkiel notes, the stock market is a device for transferring money from the impatient to the patient. By being patient and informed, investors can increase their chances of success in the market. The key to successful investing is to have a well-thought-out strategy and to stick to it, rather than trying to make quick profits or reacting to short-term market fluctuations. By doing so, investors can ride out the ups and downs of the market and achieve their long-term financial goals. In Chapter 1, Malkiel delves into the history of the stock market, from its humble beginnings to the present day. He discusses the major events that have shaped the market, including the Great Depression, World War II, and the rise of the Internet. Malkiel also explores the different types of investors, from individual investors to institutional investors, and how they have influenced the market over time. He notes that the stock market has consistently provided higher returns over the long term than other types of investments, such as bonds or savings accounts. However, Malkiel also warns that the market can be volatile, and that investors should be prepared for periods of downturns and corrections. By understanding the history of the market and the different types of investors, readers can gain a better appreciation for the complexities of the stock market and make more informed investment decisions. As Malkiel notes, the stock market is a reflection of the overall economy, and it's impossible to predict with certainty what will happen in the future. However, by studying the past and understanding the underlying trends and patterns, investors can increase their chances of success. The key to successful investing is to have a deep understanding of the market and its history, as well as a well-thought-out strategy for navigating its ups and downs. In Chapter 2, Malkiel discusses the different types of investments that are available to investors, including stocks, bonds, and mutual funds. He explains the pros and cons of each type of investment, and how they can be used to create a diversified portfolio. Malkiel notes that stocks offer the potential for high returns, but also come with higher risks, while bonds provide more stability but lower returns. He also discusses the importance of diversification, and how spreading investments across different asset classes can help to reduce risk. By understanding the different types of investments and how they can be used to create a balanced portfolio, readers can make more informed decisions and increase their chances of success in the market. As Malkiel notes, diversification is the key to reducing risk and increasing returns over the long term. By spreading investments across different asset classes, investors can ride out the ups and downs of the market and achieve their long-term financial goals. The key to successful investing is to have a well-diversified portfolio and a long-term perspective, rather than trying to make quick profits or reacting to short-term market fluctuations. In Chapter 3, Malkiel explores the concept of risk and return, and how it applies to different types of investments. He notes that higher returns typically come with higher risks, and that investors should be aware of the potential downsides of any investment. Malkiel discusses the different types of risk, including market risk, credit risk, and liquidity risk, and how they can be managed through diversification and other strategies. He also notes that investors should have a clear understanding of their own risk tolerance, and invest accordingly. By understanding the relationship between risk and return, readers can make more informed decisions and increase their chances of success in the market. As Malkiel notes, risk is an inherent part of investing, and it's impossible to eliminate it entirely. However, By understanding the different types of risk and how they can be managed, investors can increase their chances of success and achieve their long-term financial goals. The key to successful investing is to have a clear understanding of risk and return, and to invest accordingly. In Chapter 4, Malkiel discusses the importance of inflation and how it affects investments. He notes that inflation can erode the purchasing power of money over time, and that investors should take it into account when making investment decisions. Malkiel explains how different types of investments, such as stocks and bonds, are affected by inflation, and how investors can protect themselves against it. He also discusses the role of the Federal Reserve and monetary policy in controlling inflation, and how it can impact the overall economy. By understanding the impact of inflation on investments, readers can make more informed decisions and increase their chances of success in the market. As Malkiel notes, inflation is a silent thief that can erode the value of your investments over time. However, by understanding how inflation works and how it can be managed, investors can increase their chances of success and achieve their long-term financial goals. The key to successful investing is to have a clear understanding of inflation and its impact on investments, and to invest accordingly. In Chapter 5, Malkiel explores the concept of behavioral finance, and how it applies to investing. He notes that investors are not always rational, and that emotions and biases can play a significant role in investment decisions. Malkiel discusses the different types of biases, including confirmation bias, anchoring bias, and loss aversion, and how they can be overcome through education and discipline. He also notes that investors should be aware of their own emotions and biases, and take steps to manage them. By understanding the principles of behavioral finance, readers can make more informed decisions and increase their chances of success in the market. As Malkiel notes, investors are often their own worst enemies, and it's the behavioral biases that can lead to poor investment decisions. However, by understanding the different types of biases and how they can be managed, investors can increase their chances of success and achieve their long-term financial goals. The key to successful investing is to have a clear understanding of behavioral finance and its impact on investment decisions. In Chapter 6, Malkiel discusses the importance of tax efficiency in investing. He notes that taxes can have a significant impact on investment returns, and that investors should take steps to minimize their tax liability. Malkiel explains how different types of investments, such as tax loss harvesting and tax-deferred accounts, can be used to reduce taxes and increase returns. He also notes that investors should be aware of the tax implications of their investment decisions, and plan accordingly. By understanding the importance of tax efficiency, readers can make more informed decisions and increase their chances of success in the market. As Malkiel notes, taxes can be a significant drag on investment returns, but they can also be managed through tax-efficient investing. The key to successful investing is to have a clear understanding of tax efficiency and its impact on investment returns, and to invest accordingly. In Chapter 7, Malkiel explores the concept of portfolio management, and how it applies to investing. He notes that a well-diversified portfolio is essential for achieving long-term financial goals, and that investors should take a disciplined approach to managing their investments. Malkiel discusses the different types of portfolio management strategies, including buy and hold and active management, and how they can be used to achieve investment objectives. He also notes that investors should regularly review and rebalance their portfolios to ensure that they remain aligned with their investment goals. By understanding the principles of portfolio management, readers can make more informed decisions and increase their chances of success in the market. As Malkiel notes, a well-managed portfolio is the key to achieving long-term financial success. The key to successful investing is to have a clear understanding of portfolio management and its impact on investment returns, and to invest accordingly. In Chapter 8, Malkiel discusses the importance of retirement planning and how it relates to investing. He notes that investors should start planning for retirement early, and that a well-diversified portfolio is essential for achieving long-term financial goals. Malkiel explains how different types of investments, such as 401k and IRA accounts, can be used to save for retirement, and how investors can take advantage of tax-deferred growth to increase their returns. He also notes that investors should be aware of the potential risks and challenges of retirement, such as inflation and healthcare costs, and plan accordingly. By understanding the importance of retirement planning, readers can make more informed decisions and increase their chances of success in the market. As Malkiel notes, retirement planning is a critical component of overall financial planning, and it's essential to start early and be consistent. The key to successful investing is to have a clear understanding of retirement planning and its impact on investment returns, and to invest accordingly. In Chapter 9, Malkiel explores the concept of alternative investments, and how they can be used to diversify a portfolio. He notes that alternative investments, such as real estate and commodities, can provide a hedge against inflation and market volatility, and can be used to increase returns over the long term. Malkiel discusses the different types of alternative investments, and how they can be used to achieve investment objectives. He also notes that investors should be aware of the potential risks and challenges of alternative investments, and should carefully consider their investment decisions. By understanding the principles of alternative investments, readers can make more informed decisions and increase their chances of success in the market. As Malkiel notes, alternative investments can be a valuable addition to a diversified portfolio, but they require careful consideration and a thorough understanding of the risks and rewards. The key to successful investing is to have a clear understanding of alternative investments and their impact on investment returns, and to invest accordingly. In the final chapter, Malkiel summarizes the key takeaways from the book, and provides guidance on how to implement the strategies and principles discussed throughout. He notes that investing is a long-term game, and that investors should be patient and disciplined in their approach. Malkiel also emphasizes the importance of education and ongoing learning, and encourages readers to continue to educate themselves on investing and personal finance. By following the principles and strategies outlined in the book, readers can increase their chances of success in the market and achieve their long-term financial goals. As Malkiel notes, investing is a journey, not a destination, and it requires ongoing effort and dedication to achieve success. The key to successful investing is to have a clear understanding of the principles and strategies outlined in the book, and to invest accordingly. By doing so, investors can increase their chances of success and achieve their long-term financial goals.